Welcome to our interview series where we bring you face to face with the experts who manage your money. Joining me and my colleague Chirag today is Bhavesh Jain, co-head factor investing at Edelweiss Mutual Fund. Bhavesh, good to have you here with us.
Hi, good afternoon, everyone. Thank you.
Now, for the benefit of our viewers, let's start with what exactly is factor investing and how is it different from traditional investment strategies?
Sure. I think when anyone hear the word factor investing, it may sound like something fancy, something new. But if you go back and check with anyone what is growth, what is value, most of us are aware about it. So normally we call it style of investment. That is that style. If you put it in a numerical format, is nothing but factors. So quality, growth, value, then you can say momentum, size, volatility. All these normally people call it ingredients of, you can say, returns or style of investment. At Edelweiss we call it at Edelweiss we call them as factors. Now factors can be, in simple word, it can be any attributes of return which differentiate one stock from other. So like in simple word, if there are two stocks, everything is similar between them, then if you have to select one, you will select the one which is growing faster, because according to you, higher growth will be an ingredient which will give me higher returns in future. So growth over here is a factor for you. Similarly, if there are two companies, both are giving you similar return, then one with lower volatility is something you will prefer, because if returns are same, then the one with lower volatility will be a better option for me. So here you are considering volatility as a factor. Similarly, if you are trying to find out a multi-bagger, then a company with 20 lakh crore market cap versus a company with 2000 crore market cap, you will always prefer a 2000 crore market cap company, because here smaller can grow into a multi-bagger rather than a mega cap of 20 lakh crore. So here size is a factor basis which you are deciding stocks. So these are simple, you can say fundamental based or behavioral based, you can say component which distinguish one stocks from other. So traditionally India was divided into two style, which was growth and value. Now we have seen off late people have started accepting quality, or people have started accepting momentum for that matter. And now slowly and steadily we are seeing, you can say, a lot of passive funds coming onto different you can say other factors also, like volatility, beta, and so on and so forth. So yes, globally it is a well-known phenomena. In India, in last 3 to 4 years we have seen a lot of acceptance, but I think next 5 years, next 10 years, you will see a lot of fund and lot of AMCs changing their traditional style and moving to more of a rule-based and a factor-based investing philosophy.
Bhavesh, what are the key factors that you focus on, and how do you determine their relevance and potential for generating alphas in this factor investment funds?
Yeah. So see, Chirag, if you'll see, factor-based investing is not only limited to, you can say, stock selection. You can use factor-based investing for multiple purposes. So it can be stock selection, like in your traditional equity fund, you select stock using factor-based investing. Then same factor-based investing can be used for asset allocation. So in funds like Balance Advantage Fund, you use factor-based investing for asset allocation. And the same factor investing we are using in our business cycle fund for sector rotation. So there are multiple ways in which you can use factor-based investing. Now, coming to your question regarding what are the key factors what we evaluate while selecting a stock. So I think the most common factor is like same what a normal fundamental fund manager will do, which is growth. So we also keep on believing that India still is a growth market, at least for next 10 years, 15 years, 20 years. I think India will continue to remain one of the fastest growing economy. So in that context, obviously a large chunk of our stock selection is focused on growth-based strategy. So we rank all the companies on the basis of growth. So this can be sales growth, EBITDA growth, PAT growth, EPS growth. And accordingly, we look at consistency of that growth and we select stocks. So that is one of our key strategy across all the funds, but it is not on a standalone basis. So we have some strategies where we are focusing on value also. We have few funds like our business cycle fund. We are focusing growth, quality, and value. But along with that, the biggest factor we are focusing is on momentum. So momentum keeps on, you can say, giving us that belief that something which is working for last few months will keep on performing going forward also. So that's why we give a higher weightage to momentum as a strategy also in some of our selected funds. So I think if you have to ask me that any one or two, you can say, key factor which differentiate Edelweiss with other, then it will be one, consistency of growth as a factor, and second, momentum as a factor.
Bhavesh, could you explain us different funds have different mandates? So how does the factor investors come into the play in the different funds at the Edelweiss Mutual Fund?
Like any other funds, each fund will have a different mandate. Like for in large cap, you are focusing more on large cap stocks. Similarly, in business cycle fund, you are more, you can say, focusing more on sector rotation. So because each funds have different mandate, accordingly, different factors are being given higher weightage or lower weightage in each fund. So for a conservative fund, or you can say a low risk product like a balance advantage fund, or you can say a large cap fund, we will be focusing more on quality and growth as a factor. When it comes to an aggressive fund like aggressive hybrid fund, we'll be focusing more on value, or you can say momentum as a factor. Similarly, when it comes to aggressive sector rotation, again there we will not focus only on growth or value, but we will use a combination of growth plus momentum, value plus momentum, and quality plus momentum. So different funds as per the mandate will have different factors which will be getting higher weightage. The beauty of factor based investing is you have, you can say, bucket or basket of each and every, you can say, factors and each and every market cap. So you can just change the weightage, and accordingly you can construct any kind of fund. If you want large cap fund, you will give more weightage to conservative, you can say, factors, and more weightage to large cap strategies. If you want a multi cap fund, you can give equal weightage to large cap, mid cap, and you can say small cap based strategies and factors. So depending on what kind of output you want, you can control your input, and that is, you can say, the biggest advantage. A smaller team of, you can say, 2 people, 3 people, 5 people can manage an AUM of more than 35,000 crore at Edelweiss. The reason is quite simple. A fundamental fund manager at best can track maybe 20, 25, or at best you can say 50 stocks. But because everything is rule based in factor based investing, at a point of time we can track easily, you can say, NSE 500, which is the universe, or you can say the benchmark for some of our funds.
All right. So you mentioned that factors differ fund to fund, but are there any risks associated with factor investing?
Yes, like any style of investment, like for last 3 years, value is doing very well, but growth is not doing. Similarly, if you go back in 2020, you can say 2013-14 to 2019-20, value was not performing at that point of time. Growth and quality were doing exceptionally well. So like each style, there are markets where these particular factors will work, and there are markets where a particular factor will not work. That's why you will see we have single factor fund on the passive side of our, you can say, platform. So we have a mid cap momentum fund, we have a quality 30 fund in large cap, we have a alpha low volatility fund in, you can say, a large cap side. Because we know that a single factor or a dual factor, or you can say a double factor fund may or may not work at all point of time. But when it comes to active management, most of the funds, we are running a multi-factor portfolio. So we don't want to restrict ourselves to a single factor, because then it is as good as single style fund. Like growth is working, then your fund will perform, or value is working, then only your fund will perform. We don't want to get into that, you can say, lucky draw kind of scenario. And that's why in active, we are mostly restricting ourselves to multi-factor portfolio.
What are the other risk management practices do you have in place to mitigate these potential downsides?
Yep. The biggest risk of factor-based investing is you do not deep dive into any single company fundamentals. So, like if you are selecting say for example, ITC, from a fundamental point of view, you deep dive that from where the growth is coming, whether it is their cigarette business, or it is their hotel business, or it is their FMCG business, and then you try to predict that what will happen in next 3 years, 5 years in that particular sector, and then you try to, you can say, discount the cash flow and try to calculate present value of that particular stock, and then finally you conclude whether it is cheap or expensive. So you actually go deep dive into that company. When it comes to factor-based investing, you are using more of a ranking methodology. And when you, as I told you, I can track 500 companies compared to a fundamental fund manager who will track 25 companies. So the risk is I am tracking 500 companies where I'm not deep diving into any of these 500 companies. So if at all there is some, you can say, stock specific issues, it can be corporate governance issue, it can be, you can say, liquidity issue, it can be balance sheet issue, or it can be some sector specific news. This can take a big hit on your factor-based investing portfolio. And that's why as a risk management tool, you will see all our portfolios are extremely diversified. We don't restrict ourselves to single factor, as I already mentioned you. Normally, we keep 50 to 60 stocks in our portfolio rather than having a concentrated portfolio, because per stock risk has to be managed because you are not going deep dive into that particular stock. Other than that, we have a separate risk management team which eliminates some of the stocks using their, you can say, their own analysis, which is an independent analysis. They do, you can say, forensic analysis. Then they check for promoters' track record, corporate governance issue, liquidity of each and every stock. And basis that, they eliminate, or you can say in a way give us a blacklisted you can say universe, that out of our universe of say top 300 company or top 500 company across different portfolios, there will be 20, 30, 40 stocks which are blacklisted from our risk team, which we cannot buy in any of our fund. So this is, in a way, you are trying to eliminate stock specific risk in your portfolio. Beside this, depending on which kind of product we are managing, like in our large cap fund or in our balance advantage fund, which are supposed to be, you can say, slightly lower on volatility, there we have some, you can say, over and above this risk management policy, we have our own limitation. We will not purchase any non-nifty stock more than 2.5% in our portfolio. Similarly, some of the portfolio where we are being benchmarked against, you can say, some of the index, we try to keep our sector weight, you can say, plus or minus 5% compared to the sector weight in that particular index. Similarly, when it comes to an aggressive fund, like you can say business cycle fund, here the cap is we cannot take more than 40% position into a single sector. And as I already told you, in most of the funds, we try to cap ourselves, the universe in top 300 or top 500 market cap companies, so that extremely smaller companies are not part of our, you can say, factor-based investing product. Beside this, we also have, you can say, stock-specific risk management policies, wherein, as the mutual fund rules already suggest, that we cannot take more than 10% position into a single stock. We, in some of the funds, we already have a cap where we will not take more than 2% position into a single stock, 2.5% position into a single stock, if it is not part of my benchmark. So these are some of the, you can say, additional risk management practice which we follow. See, the simple philosophy of factor-based investing is, if there is a product or if there is a category of product where improving return is very difficult, like in large cap, today generating alpha in large cap is extremely difficult. So in that scenario, what we do, we try to keep return same, but we reduce volatility by 20, 30, 40%. So on a risk adjusted basis, you are getting a much better product. Or there are products where you are supposed to be aggressive, so we try to keep same risk but generate much higher alpha.
As you mentioned, you don't look at the financial parameters of each of the companies. So what is the key difference between the factor investing and other active funds, and how do you select the stocks in this kind of segment?
Okay, so say for example, let's take Nifty 50 as the benchmark. Out of this Nifty 50 stocks, I have to select 10 stocks which are best on growth or best on growth plus momentum combination. So what we do, you have Nifty 50 companies. After the quarterly result, you will get growth number for all the 50 companies. So stock which has given you highest sales growth will be rank 1. Stock which has given you lowest sales growth will be rank 50. Then similarly, along with sales growth, you also give ranking on the basis of EBITDA, PAT. So stocks with highest EBITDA growth, stock with highest PAT growth will be rank 1, and stock with lowest EBITDA growth, lowest PAT growth will be rank 50th. And then you will average this rank. So sales growth, EBITDA growth, PAT growth, EPS growth, you will take average of this. This average will be your growth rank. In addition to that, we also calculate momentum score. So momentum score is stock which has given you highest return in last 3 months will be rank 1. Stock which has given you lowest return in last 3 months will be rank 50th. And then stock which has given you highest return in last 12 months, which is 1 year, will be ranked 1. And lowest return in last 12 months will be rank 50th. You will take average of 3-month rank and average of 12-month rank. This is your momentum rank. Now, as a mandate, you want a portfolio which is better on growth. So what I will do, I will take out of this 50 stocks, 25 stocks with highest growth rank or the best growth rank. So that will be my growth portfolio. And now within that 25 stocks, I will select 10 stocks with best momentum. So here you will see I am not trying to predict anything of future. What will happen in those stocks in next 1 year, 6 months, 3 months. I am not bothered. I am just ranking on the basis of historical growth. I am just ranking on the basis of historical returns. It can be 3-month return, it can be 6-month return, it can be 12-month return. So basis that, I have identified stock which has given me the best growth. And then within that best available stocks on the basis of growth, I have selected the stock which has given me best returns. So this is my 10 stocks portfolio of growth plus momentum.
Bhavesh, you've been managing Edelweiss Arbitrage Fund for over a decade. what interested you towards managing the arbitrage side of the market?
So, see, I joined Edelweiss in 2008, so almost 16 and a half years, and I'm doing arbitrage for, so almost last 16 and a half years. So, Edelweiss as a group is always known for, you can say, as a pioneer for derivative trading, and that is how I joined Edelweiss in 2008 directly from my campus, purely for managing, you can say, derivative trading and all that stuff. So in 2008, I joined Edelweiss, you can say, India Diversified Fund, which was an hedge fund managed by Edelweiss at that point of time, in the low risk trading strategy, where I was doing arbitrage between, you can say, normal Indian stocks, index arbitrage, and also arbitrage between SGX Nifty and Indian Nifty at that point of time. So that is how I learned, or I started my career as an arbitrage trader. Then when I moved into Edelweiss Mutual Fund from 2011, I started doing arbitrage in our existing product, which was a Balanced Advantage Fund, earlier known as Absolute Return Fund. Then looking at the track record from 2011 to 2013, you can say 2013 second half or 2014 start, looking at the track record of our arbitrage performance in, you can say, as a small segment of Balanced Advantage Fund, we thought that this is a product, this is a, you can say, strategy which we can launch as a product, because that time arbitrage fund was already there but not that popular. But we thought that rather than, you can say, fighting in much competitive categories like large cap, mid cap, small cap, this will be a easy battle for us to win, because we are known for arbitrage, and that point of time the category was just 5,000 crore. We launched our NFO in 2014 June, and in NFO we garnered close to 58 crore. And from that day till date, I'm managing this arbitrage fund, and size obviously from 58 crore, which was 1% of overall market at that point of time. Today is almost at 12,000 crore. We are close to 6% of market share today. Now, the biggest, you can say, the reason why we kept on, you can say, performing better in arbitrage is the learning which we had in the beginning part of our career. So today you will see some of the biggest arbitrage fund in the industry are managed by ex-Edelweiss employees. So that clearly shows that Edelweiss have a huge pedigree as far as derivative trading and arbitrage strategies are concerned. For us, I think, see, it is quite simple. Finally, what client want is better post-tax adjusted return for his, you can say, investment. Now, if you don't want to take equity risk, then fixed income is the only alternative. Now, within fixed income, you try whatever you want to. In 2014, the first leg of tax change happened. Then last year, second leg of taxation change happened. And this year budget, next, you can say, steps of changes have happened, which have, you can say, in a way, change the taxation of fixed income in a big way. And now to get a better alternative with similar risk profile, I will not say exactly same, but similar, because in arbitrage, you are not 100% into, you can say, fixed income securities. You are doing arbitrage between equity stocks and equity future. So you are completely hedged. Market goes up by 20% or market goes down by 20%. You are actually not bothered, because your total position is entirely hedged. But in this process, you end up giving a fixed income kind of experience to your client with a much better taxation, because finally it is an equity product. You have more than 65% of your portfolio into equity stocks, which are completely hedged, and the taxation is much better over here.
Right, that's about arbitrage fund, but you have some 23 different funds under your management at Edelweiss, now spanning various strategies. So how do you effectively divide and manage the workload? Can you explain that?
Yeah, I think the total AUM which I'm managing is close to, you can say, 35,000 crore across multiple schemes. As I told you, we are, you can say, managing most of our active funds within my team on the basis of factor-based investing. And as already mentioned, the biggest advantage of factor-based investing is 1%, 2%, 5% smaller team can manage as many funds as you want, because everything is, you can say, process driven. Everything is rule based. So you don't have to use your discretion. You don't have to, you can say, deep dive into each and every, you can say, stock. You don't have to attend each and every management call. You don't have to, you can say, go through all their conferences and all that stuff. So that gives us a quite, or you can say, ease of operation of managing so many different funds. We have a dedicated, you can say, research team. We have a dedicated dealing team. We have a co-fund manager structure in all our funds. All this thing helps us, you can say, to, you can say, manage more number of schemes with less number of people. Independent risk team is also helping us, because a lot of, you can say, corporate governance issue or you can say other filters are being managed separately, independently. So all that biasness of, you can say, selecting or getting biased to your selection are being taken care of, because a separate independent risk team is doing all the due diligence for all the universe stocks, all the stocks of the universe. It is not only your portfolio, but the entire universe, which is being checked by them on a regular basis. So all this thing definitely helps you.
The Edelweiss IPO fund. Could you share with us what is the strategy of this fund, and how do you evaluate the IPO and select the stocks?
Yeah. So if you see, we launched this fund in 2018 February as a close-ended fund, because it was the first product in the entire industry where this fund was dedicatedly launched to participate in all upcoming IPOs and all the IPOs which are listed, all the last 100 IPOs which are listed on main board. Now, the biggest problem what an investor face in IPO was, number one, selection. Which IPO is good, which IPO is bad. Normally, if you will ask to people on street, most of them select IPO purely on the basis of herd mentality, or at best they track gray market premium. Second is, even if you are able to select a good company in for, you can say, participating in IPO, the second problem was allocation. A good company coming up with IPO get oversubscribed 50 times, 100 times, 200 times, and then in lottery system, you may or may not get that allocation. And the third was, even if you are able to select the right company, you are able to get the allocation, then when to exit. Most of the companies, people, if they get allocation in, you can say, IPO, say for example, DMart, you got allocation in IPO at 300 rupees, stock listed at 600 rupees. You thought that I am making 100% return in one day, you exit. And now that DMart from 600 rupees today is at, say, close to 5,000. So post-listing gain is the biggest game which we wanted to play when it comes to IPO fund. So to solve this multiple problem, we thought that we will launch a product which will participate in all upcoming IPOs along with last 100 listed IPOs. So it was a thematic fund. 80% of our AUM will always be deployed in last 100 IPOs. Now here, as I told you, the biggest problem one faced was selection. Here, as we are onto the, you can say, buy side, we are a domestic, you can say, mutual fund. So before IPO, we get opportunity to meet the lead manager, to meet the investment banker who is coming up with this IPO. We speak to their analyst. They teach us how to evaluate a particular sectors, because there are many new sectors which have come up with IPO in last 5 to 7 years, which you would have not got an opportunity to evaluate in your historical experience. Like when a loss-making company for an IPO, historically there was no loss-making company which can come with IPO. But as per the new rule, even a loss-making company can come with an IPO. So how to evaluate this company, a food delivery company, or there are various other sectors which have opened up recently. So that is how we try to play that an important role. We get an opportunity to meet each and every promoter before IPO. We get opportunity to meet their top management. We also get opportunity to visit their plant, factories, offices, to meet their competitors, to meet their vendors. So in a way, we have much more information compared to a normal retail investor, and because of that better source of information, first-hand information, our selection is much better compared to a normal individual investor. Even after running a dedicated IPO fund, if you will see, out of 100 IPOs which comes every year, our participation is only in 35 to 40 stocks. That means 60 stocks we eliminate or we reject as far as because of our selection process. So while evaluating a company, we look at various parameters. The most important is whether the growth will be a secular growth company or it will be a cyclical growth company. Basis that we decide whether we want to participate as an anchor investor or for a longer period of time, or we just want to play the listing day gain or the short term, you can say, tactical trading opportunity. And then also getting, you can say, some of the comparison of how internationally the companies are benchmarked, that a food delivery company in India is getting listed for the first time, but there are, you can say, peers in international markets which are already listed. So how internationally that company is getting, you can say, analyzed versus how we should analyze that company in Indian market. All this, you can say, information gives us that added advantage. And I think we have been able to do a great justice to, you can say, all our clients. The NAV of the fund, which we launched in 2018 February with 10 rupee, today as we speak is almost at 26, 27. So close to 170% returns have been generated for our clients in last, you can say, 6.5 years. So I think one should definitely look at IPO with a positive mindset. Yes, within IPO also, you can say there can be, as I told you, each strategy have their own advantage and have their own disadvantage. Similarly, over here also, in you can say euphoria kind of market, like 2021 second half, or what we are seeing right now in some of the SME names, SME IPO, though we don't participate in SME IPO, but there are, you can say, few pockets where you have to be extremely careful, particularly when we are seeing, you can say, crazy stuff happening. We have seen in 2021 second half on main board also, and now also we are seeing, you can say, some sign of that in happening in SME. So one has to be extremely, you can say, careful while evaluating IPO, and that's why we say that a fund-based approach is much better rather than, you can say, individually participating in those IPOs.
Since exit strategy in IPO is not easy, what are the steps you take to exit the stocks from this fund?
So as I mentioned, in this particular fund, it is a thematic fund. So 80% always has to be in last 100 IPO. So if say 20 new IPOs come, 20 old IPOs move out of my universe, I can still keep 20% weightage in those stocks which are already out of my universe, but that number is just kept at 20 because 80 has to be in last 100 IPO. So one, if the stock moves out of my universe, then beyond 20% I cannot hold. So I will be compulsorily exiting. But that will be, you can say, the last case scenario. Before that, the fundamental principles what we follow while exiting any company is, number one, the biggest one is, if the management change their, you can say, goalpost. At the time of IPO, they said that we will use this money for XYZ thing. And once the IPO is over, and then next 6 months to 1 year, they change their goalpost and start using this proceeds for some other purpose. So as I told you, for us, the investment, you can say, holding period is 2 to 3 years, because every year there are 35, 40 IPOs which are coming. So 100 IPO will be a universe of 2.5 to 3 years. So if a management change their goalpost that suddenly from business X, we are going to business Y, which will take away that our path to profitability further by 2 to 3 years, then we will exit those stock. Then second, like in any other funds, if there is a negative news or a corporate governance issue in any of your portfolio company, this is not only for IPO fund, for any of your fund, large cap, mid cap, small cap, the same philosophy. If there is a, you can say, any corporate governance issue, if there is any negative news of the sector or for that particular company, we will definitely exit that stock. If our price target has already been achieved, because we have seen in IPO, there are some IPOs where price move much ahead of the fundamentals. And if the price is already in our target zone, then definitely we will exit. So valuation, you can say, in a way, is a it can be a, you can say, proxy for deciding which stock we can exit just because of the target price target getting achieved. And the most important one will be, if say for example, like in one of the company where it was a monopoly, you can say, a ticket booking company, where suddenly government decided that we will charge some royalty, we exited that stock, because though after that government, you can say, took back that decision, but for us, if once such thing happen, as a risk management policy, we will not wait that this decision may get reversed or not get reversed. For us, it is an risk management issue, so immediately we exited that stock. So there can be multiple way through which we can exit, and the most important will be, if I get another big or better opportunity, then obviously I will replace my existing stock with that better opportunity, either because of valuation or because of growth prospect. So that is always there. So relative comparison is also one of the reasons through which we can exit company.
All right. Now, before we wrap up this interview, can you please tell us which market segment do you think is currently overvalued, and where do you see too much speculation happening?
So I think, see, valuation is something which we are not a firm believer of, because we think that market can remain expensive for a prolonged period of time, and then it doesn't make any sense just to look at valuation and exit from the market. You have to manage your risk, so you have to manage your asset allocation, and then you can continue to participate in those particular, you can say, sectors or segment. Right now, if you ask me, as I already mentioned about SME as a, you can say, basket, where I want everyone to be very careful because of some of the crazy stuff we are seeing over there. Beside that, yes, right now, when you look at small cap overall or mid cap overall, I think this is a time where we normally say this is an accumulation phase. You cannot put lump sum money in small cap and mid cap today. You have to come in a gradual, you can say, staggered manner. Then there are few sectors where we are seeing a lot of, you can say, people are launching sectoral fund into a very, you can say, narrow segment. There are only 10 or 12 or 15 companies in that sector, and then we are seeing sectoral funds getting launched over there. So obviously we are, you can say, slightly hesitant to look at some of the, you can say, sector specific funds where we think risk return has already played and then now incrementally it is not that attractive to continue investing in that particular sector. So for me, if you ask me, we always, as I told you, if you cannot improve your return, then at least try to cut down your risk. So for large cap or large cap oriented category, today we recommend you can say hybrid fund like balanced advantage fund or aggressive hybrid fund. Similarly, for all your sectoral fund, we recommend fund like business cycle fund, where at least in a, you can say, a process driven way, you will shift from one sector to other rather than sticking to one particular sector. Because we have seen sector allocation is purely tactical in nature. If you stay invested in sector fund for, you can say, a long period of time, you are actually not able to beat the benchmark in most of the cases. So I think this is how, if you are not able to improve your return, cut down your risk, move into a conservative product within the same category. So that has been our philosophy and our advice to most of our partners also.
All right. Well, thank you, Bhavesh, for answering all these questions and taking the time out for this interaction. Thanks.
Thank you.